Hi, this is Terry, and we're going to do two topics, but I think what I'll do is split them into two different videos. So the first one is going to be the variable costing, and then a separate video will be segment reporting. So we'll just continue on with variable costing for uh, this chapter. All right, need job order costing. So let me write that at the top here. Oh, turn on my ink. Job order costing. We never really gave it a name, and what it is absorption costing. The absorption costing is what is required to follow GAAP, generally accepted accounting principles. And it's mandatory that you use this method, but there's an alternative method called variable costing, and that's what we want to do is to examine why it exists and why it's important and what value it has. So I did a screen capture from a different slide, different handout, and I think this works to get the point across here. When we studied job order costing, we had materials. So our direct materials went into work in process. We added labor, and then what we did was we applied overhead. And that overhead, we made no distinction between variable overhead and fixed overhead. Those costs then flow through work in process and go to finished goods. And then at the point that we sell our product, then that finished goods then becomes an expense. So at this point in time, all of these are inventory accounts, and that's what we learned. So going back to our handout, under absorption costing, we have our direct materials. We have our direct materials, which is variable by definition, because the more you make, the more materials you need. We have direct labor, which is variable, because again, the more you make, the more labor you need. Then we have variable overhead, which obviously is variable. That would be like grease for the machines, because the more you use the machines, the more grease you need. And then fixed overhead, and fixed overhead, for example, would be property taxes, insurance, depreciation on the equipment. And for selling administrative, then we'd have variable selling costs. Um, for example, shipping would be both. We could have variable shipping and we could have fixed shipping. So the variable shipping would be maybe the packaging, and then the fixed shipping costs would be the employees that are on salary. So let me get rid of a little of this and kind of erase all that. There we go. And back to pen. So going to variable costing now, we're going to organize our income statement differently. So up above we had sales minus cost of goods sold is gross margin, minus operating expenses is net income. What we're going to do now with variable costing is say sales minus variable is contribution margin minus fixed is net income. And again, I apologize for my writing. I'm writing on a screen that's at a tilt, and this is kind of the best I can do. All right, so our variable cost then would be our direct materials, it would be our direct labor, it would be our variable overhead, and our variable selling and administrative. Then our fixed expenses would be our fixed overhead and our fixed selling and administrative. So the whole point of this chapter is that fixed manufacturing costs are no longer going to flow through with the goods. So should I go back to that slide before? Oh, so back to that previous handout. Again, this is the whole point of this whole chapter is this applied overhead is variable plus fixed. And if we sell or finish the product and send it to finished goods and then sell it, it reaches the income statement because the cost of goods sold is on the income statement. If the product is not sold, it sits here in ending inventory of finished goods. So here's the rub. This is what managers can do. Remember that fixed overhead is allocated over all the units made. So let's say we had $100,000 and we made 10,000 units. So the fixed overhead would be $10 per unit. But what if we overproduced and made 20,000 units? Now each unit would only have $5 of fixed overhead. So although we sent 10,000 units that we sold, now we've got another 10,000 units, so 10,000 units, sitting in finished goods, but what reached the cost of goods sold is now at a cheaper price. And that's the whole chapter, that under absorption costing, the fixed overhead follows the goods, and if the goods are not sold, that fixed overhead hides in ending finished goods. And if it is sold, then it hits the cost of goods sold. It hits the income statement. So what managers can do is overproduce. Then what hits the income statement is going to be cheaper. So the lower the expense, the higher the net income. The higher the net income, the better the bonus for the managers. So moving to the next slide on the handout, this is just visual representation of what's going on. That materials, labor, and variable overhead go into work in process. Under absorption costing, so does fixed overhead. But under variable costing, that fixed manufacturing overhead is now no longer a product cost, it becomes a period cost, and therefore there's no incentive for managers to overproduce and waste resources and tie up cash if you use this method. So let's see an example here. And okay. All right, so let's put some numbers together and see if this makes sense. We're going to produce 25,000 units, and the selling price is going to be $30. So if we just use these numbers and say that the direct materials, so the variable materials, the variable labor, the variable manufacturing overhead is $10. And then we say the variable selling is $3. And again, just use these figures. Fixed manufacturing overhead is 150 and fixed selling is 100. Then what that does, it means that under absorption costing, the units are going to travel at $16 a unit. And how did we come up with that? The direct materials, direct labor, and variable overhead are 10. And then if we take this $150,000 divided by the 25,000 units, then the fixed overhead broken down per unit is $6. So now we're sitting at 16. So I've cleared off the ink, and I think we want to walk through this to make sure you understand what's going on. So we're going to produce 25 but only sell 20. So by definition, we are going to store in finished good 5,000 units that were not sold. So if we look at our numbers and we sell 20,000 and the selling price from the numbers up above was 30, that's 600,000, the same as it is under variable costing. So we've got two income statements here, the variable costing way and the absorption way. So the absorption way, 20,000 at $30. Cost of goods sold is at 16, so that's 320. Gives us gross margin of 280. Under absorption costing, we don't differentiate between variable and fixed, so those just have to be added back together. And we see that our net income's 120. If we do variable costing, and again remember that this is the contribution approach, so it's sales minus variables contribution minus fixed is net income, then we see that the variable cost of goods sold is only 10. And again, the 20,000 units at 3, just like up above, is going to be 60,000. We have a contribution margin of 340. Our fixed expenses, 150, goes directly to the income statement, and then the selling administrative is 110, or excuse me, 100. So when we have the 100 here and the 60 variable, I don't like that jumping. Go back, there we go. So the 60 variable, honest to gosh. All right, so you'll notice that net income here is 120 under absorption costing, but is only 90 under variable costing. So what we want to do is look at what's the reason why. The sales won't change. So we're going to sell 20,000 units at 30. We're going to have $600,000 in sales either way. But what does change is the cost of goods sold. So remember from our numbers above that $10 was the direct material, the direct labor, and the variable overhead. Then the fixed overhead was another $6 because that was $150,000 in overhead divided by the 25,000 we produced. So this is all going to be at $16 per unit. The selling administrative expenses, again under absorption costing, we didn't separate the variable and the fixed, so now we're just going to add them together. $3 variable times the 20,000 we sold plus the fixed of 150. We see that we have 120 for net income. How this is different with this method is the variable cost of goods sold now is at $10. So just the direct material, the direct labor, and the variable overhead. The fixed overhead under this method goes directly to the income statement in the current period. So what's happening is we're getting 200,000 plus the 150, or a total of 350,000, as opposed to 320,000 hits the income statement because 5,000 units and $6 of that fixed overhead gets stored in finished goods and doesn't hit the income statement. So therefore we have 320 versus 350. That's the difference of this $30,000. So in finished goods, sitting in this ending finished goods is 5,000 units that has $6. It's a total of 16, but $6 of that 16 is fixed. Can I write small enough? Fixed. Whereas under the variable costing method, that fixed overhead now becomes a period cost. So up here, it's stored, and down here, It hits the income statement no matter what. Now here's the reason. The variable costing method does not allow managers to manipulate net income. By overproducing that 150,000 instead of being divided over 25,000 units, what if we made 30,000 units? So the 150 divided by the 30,000 would now be $5 instead of 6. So we just lowered the cost that hits the income statement by overproducing. By overproducing, then our net income will be higher. When our net income is higher, managers make bigger bonuses. Absorption costing is the gap is gap. Therefore, variable costing cannot be used. So the smart thing to do is to base all the bonuses that you give managers based on the variable costing method. But you have to remember that variable costing cannot be used for tax purposes. You have to use absorption. I'm going to clear the ink here because there's so much of it, and just arrow down. And what you'll see is another example, and I'll let you go through this on your own. But here's the deal. If I make this a little smaller, will it all fit? There we go. So in the first year, we're going to have the absorption costing versus variable. You're going to make 5,000 units and sell 5,000. So the ultimate issue is there's no difference in net income because you sold everything you made. In the year 2, you're going to make 5,000 but only sell 4. Therefore, you're going to store 1,000 units in inventory. That's why you're going to have a difference in net income. And what you'll see if you look at the numbers up above, the fixed overhead, can we go up there? The fixed overhead is this $3. $15,000 in fixed overhead over the 5,000 produced. So when we look at this again, you'll see that there's 1,000 units at $3 per unit doesn't hit the income statement where all 15,000 does. Then the reverse is true. In year 3, we make 5,000 but we sell 6. We're going to sell the 1,000 from the previous period, from the previous year. And now you're going to see the difference is 3,000 the opposite direction, that it's $3,000 cheaper. And why is it cheaper? Because the fixed not cheaper, less income, so a lower income. And the issue here is, why is that lower income? Because the stored 1,000 units with $3 per unit now hits the income statement, which brings net income down, but does not affect the variable costing method because it hits the income statement in the period that it occurred. All right, I think that's enough for this topic. Certainly you can look at the rest of the handout, and I'll clear the ink just to show you there's a little bit more that you can look at. All right, thanks.
I am what I am, and that's all but I am. I'm Popeye the Sailor Man.